Cryptocurrency isn't just digital money, it's a fascinating blend of advanced mathematics and cutting-edge technology. Behind every transaction, blockchain, and market prediction lies the power of math. In this video, we'll explore how stochastic processes help model price movements, how calculus ensures secure cryptographic protocols, and how linear algebra drives the algorithms behind mining and encryption. If you're curious about the math that fuels this revolutionary technology, stay tuned, you're about to uncover the numbers that make crypto tick. Cryptocurrency operates in a world of data, predictions, and complex systems. Behind every price movement, every blockchain transaction, and every cryptographic protocol lies mathematics, the invisible force shaping how crypto works. Concepts like stochastic processes, calculus, and linear algebra are at the core of this digital revolution. Stochastic processes help make sense of the unpredictable nature of cryptocurrency markets. Prices often behave in ways that seem random, but by analyzing probabilities, traders and analysts can identify patterns within the chaos. For example, the stochastic oscillator is a popular tool for determining whether an asset is overbought or oversold. It uses probability to signal potential price reversals, giving traders a better chance to act strategically. Random walks, a common stochastic model, simulate price trajectories to show how historical data and randomness influence future movements. These models enable traders to create strategies that account for volatility and risk. Calculus, the study of change, plays a pivotal role in understanding market dynamics. Derivatives are used to calculate the rate of price change, providing insights into market momentum and direction. Integrals, on the other hand, help analyze cumulative metrics like trading volume, giving a clear picture of market activity over time. Calculus isn't just limited to trading, it's also a vital tool in blockchain technology. Mining efficiency, transaction validation, and energy optimization all rely on differential equations to ensure that blockchain networks perform effectively. Traders and developers also use Monte Carlo simulations, a calculus-based method, to predict potential outcomes in volatile markets. By running thousands of scenarios, these simulations give a probabilistic view of future price movements. Linear algebra underpins many technical aspects of cryptocurrency. Cryptographic systems, such as elliptic curve cryptography, rely on vector spaces and matrix operations to secure transactions. These systems make blockchain networks robust and ensure that private keys remain unbreakable. Linear algebra also powers decentralized finance platforms. Liquidity pools, a backbone of DeFi, use matrices to model token balances, ensuring stable and efficient trading. For traders working with vast amounts of data, linear algebra tools like principal component analysis simplify complex datasets. This allows them to focus on the most critical factors driving market changes, giving them an analytical edge. Mathematics is not just a supporting player in cryptocurrency, it's the foundation. Stochastic processes, calculus, and linear algebra work together to predict, optimize, and secure every aspect of the crypto ecosystem. These mathematical principles ensure that blockchains function smoothly, transactions remain safe, and traders have tools to navigate volatile markets. As cryptocurrency evolves, the role of mathematics will continue to expand, powering new innovations and unlocking greater potential in this digital frontier. Stochastic processes predicting price movements and market trend. Stochastic processes model randomness and uncertainty, making them ideal for understanding and predicting cryptocurrency price fluctuations. Use stochastic oscillators to identify overbought or oversold conditions in the market. This helps in making informed buy or sell decisions. Implement Monte Carlo simulations to estimate the risk of different trading strategies under various market conditions. Employ Brownian motion models to predict long-term trends or price volatility. Calculus optimizing cryptographic protocols and analyzing growth rates. Calculus is essential in blockchain operations and cryptography. It's also used to analyze transaction speeds and network scalability. Use differential equations to understand how the value of a cryptocurrency evolves over time. Apply integral calculus to measure cumulative transaction volumes or compute hash rates over time. Optimize staking or mining rewards using rate of change calculations, ensuring you maximize returns based on real-time data. Linear algebra enhancing cryptographic security and data analysis. Linear algebra forms the backbone of encryption algorithms and is essential in data science for analyzing large sets of crypto-related data. Implement matrix operations to understand and predict market correlations. For instance, you can study how Bitcoin's movement influences other altcoins. Use linear algebra to optimize mining algorithms, ensuring efficiency in solving cryptographic puzzles. Leverage vector spaces to analyze blockchain structures and improve transaction processing. How to integrate these strategically? Data-driven decision-making. Combine stochastic analysis with calculus to monitor trends and adjust trading strategies dynamically. Portfolio optimization. Use linear algebra to identify low-risk asset combinations and maximize diversification. Innovative solutions. Apply these mathematical tools to create or refine blockchain projects, enhancing security, scalability, or usability. By mastering these mathematical techniques, you can gain a competitive edge in cryptocurrency, whether you're trading, mining, or developing blockchain technologies. To pick trades in cryptocurrency using stochastic processes, calculus, and linear algebra, you'll need to combine mathematical analysis with practical market strategies. Each of these fields can be applied to improve decision-making, manage risk, and optimize returns. Here's how to use them strategically in trading. Stochastic processes identifying trade opportunities. Stochastic processes help you understand market randomness, which is crucial for predicting price movements and identifying entry and exit points. The stochastic oscillator compares a cryptocurrency's closing price to its price range over a specific period. It fluctuates between 0 and 100, indicating overbought, above 80, or oversold, below 20, conditions. Overbought/oversold signals look for buy signals when the oscillator is below 20 and a sell signal when it's above 80. Crossovers buy when the fast line crosses above the slow line in oversold territory, bullish signal, and sell when the fast line crosses below the slow line in overbought territory, bearish signal. Monte Carlo simulations. Monte Carlo methods allow you to simulate potential price paths, based on historical volatility and randomness. By generating multiple simulations, you can gauge the likelihood of various market outcomes. Risk assessment. Use the simulations to understand the potential risks associated with entering a trade at a certain price point and make more informed decisions. Portfolio diversification. Monte Carlo can help you optimize your portfolio by simulating a range of outcomes for different cryptocurrencies. Calculus optimizing entry and exit points. Calculus can be used to optimize your entry and exit points by analyzing the rate of change in price movements and transaction speeds. Derivative calculations. Rate of change. Use derivatives to measure the speed at which cryptocurrency prices change. By studying the first derivative, the rate of change, you can gauge how fast the price is moving and decide when to buy or sell. Identify trends. Look for periods where the price is rising, positive derivative, and consider entering the market, or look for declining derivatives as a signal to sell. Optimize entry points. Use second derivatives, acceleration, to identify when price movements are speeding up or slowing down. A steep acceleration could indicate an impending price surge. Optimization models use integral calculus to estimate the cumulative return over a period or calculate transaction costs. Maximize returns by integrating price movements over time. You can estimate the total returns you would have made over a period, helping you time trades better. Transaction cost analysis optimize trading fees and slippage to improve overall profitability. Linear algebra analyzing market relationships and risk management. Linear algebra is essential for data analysis, helping you find correlations between different cryptocurrencies and manage risk. Correlation matrices construct a correlation matrix to analyze how different cryptocurrencies, for example, Bitcoin, Ethereum, move in relation to each other. Linear algebra operations can help identify these relationships. Diversification. If two cryptocurrencies have a low correlation, you can combine them in your portfolio to reduce risk. Risk-return analysis. Use matrix operations to identify optimal combinations of assets that maximize returns while minimizing risk. Eigenvectors and eigenvalues. These concepts can be used to perform principal component analysis, PCA, a technique that reduces data complexity while preserving key factors that explain market movements. Market trend identification. Use PCA to identify the dominant factors influencing a cryptocurrency's price. By focusing on these factors, you can better predict price movements and trade based on core market trends. Integrated trading strategy. Using all three to pick cryptocurrency trades, combine stochastic processes, calculus, and linear algebra to form a cohesive trading strategy. Market trend analysis. Use stochastic processes to identify overbought or oversold conditions and predict potential market reversals. Apply calculus to determine when price acceleration, first and second derivatives, signals a good entry or exit point. Use linear algebra to assess correlations between assets and optimize a diversified portfolio to reduce risk. Risk management. Simulate potential outcomes using Monte Carlo simulations and employ linear algebra to calculate risk-return trade-offs. Use calculus to optimize your position sizes and ensure you're not overexposed to market fluctuations. Optimization. Implement stochastic models to predict price paths and use linear algebra to optimize your portfolio for the best risk-adjusted returns. Use calculus to determine the best entry and exit points based on the rate of price change. By blending these mathematical disciplines, you can make more informed, data-driven decisions that improve your chances of success in the cryptocurrency market. From the randomness of stochastic models to the precision of calculus and the structure of linear algebra, mathematics is the unseen engine driving cryptocurrency's success. Understanding these concepts not only gives you a deeper appreciation of crypto but also a glimpse into its immense potential. If you found this breakdown insightful, don't forget to like, share, and subscribe for more deep dives into the science behind technology. Let us know in the comments which aspect of crypto math fascinates you the most. Thanks for watching, and we'll see you in the next video.